Murabaḥah, Murabaḥah or Murabaḥah is a term of Islamic fiqh jurisprudence for a sale where the buyer and seller agree on the markup for the item being sold. In recent decades it has become a term for a form of Islamic financing, and involves the buyer using Murabaḥah as a mechanism to borrow money, paying the seller the marked-up price with deferred payments. It has been called the most prevalent or default type of Islamic finance, because the buyer-borrower pays the seller-lender at an agreed-upon higher price, instead of interest charges. The contract involves a profit on the sale of goods, which is permissible in Islam. Some conservative Islamic finance scholars consider Murabaḥah as a transitory step towards a true profit and loss-sharing mode of financing, and a form to be used where profit and loss-sharing is not practicable. The basis of Murabaḥah financing has been called cost-plus, and is similar to a rent-to-own arrangement, with the intermediary retaining ownership of the property until the loan is paid in full. A Murabaḥah differs from conventional loans in a number of other ways. After the Murabaḥah contract is signed, the amount being financed cannot be increased in case of late payment or default, nor can a penalty be imposed, unless the buyer has deliberately refused to make a payment. The seller also has to assume any liability from delivering defective goods. Sources differ as to whether charges for late payments are allowed, with some authors stating late fees ought to be donated to charity. Proper Murabaḥah involves guidelines to ensure that a Murabaḥah transaction is based on trade between the bank and the customer and not merely a financing transaction. Skeptics complain. Note that in practice most transactions are merely cash flows between banks, brokers and borrowers, with no buying or selling of commodities, that the profit markup is based on the prevailing interest rate used in haram lending by the non-Muslim world, that the financial outlook of Islamic Murabaḥah financing and conventional debt loan financing is the same, as is most everything else besides the terminology used. Islamic finance use varieties. Murabaḥah is one of three types of bayu al-amana, requiring an honest declaration of cost. The other two types are tawla and wadiyah. The accounting treatment of Murabaḥah and its disclosure and presentation in financial statements vary from bank to bank. If the exact cost of the item cannot be or are not ascertained, they are sold on the basis of musawama. Different banks use this instrument in varying ratios. Typically, banks use Murabaḥah in asset financing, property, microfinance and commodity import-export. Many scholars believe that the seller may not use Murabaḥah if profit-sharing modes of financing such as murābaḥah or musharaka are practicable, but since those involve risks, they cannot guarantee banks' income. Murabaḥah, with its fixed margin, offers the seller a more predictable income stream. One estimate is that 80% of Islamic lending is by Murabaḥah. The International Monetary Fund reports that Murabaḥah transactions are widely used to finance international trade, as well as for interbank financing and liquidity management through a multi-step transaction known as tawarrut, often using commodities traded on the London Metal Exchange. Author Harris-Hyphen writes that use of Murabaḥah has become so distorted from its original intent that it has become the single most common method of funding interbank liquidity and corporate loans in the Islamic finance industry. A number of economists have noted the dominance of Murabaḥah in Islamic finance, despite its theological inferiority to profit and loss sharing. One scholar has coined the term the Murabaḥah syndrome to describe this. Bay-Alina, one simple form of Murabaḥah, known as Bay-Alina, was used by a number of modern Islamic financial institutions despite condemnation by jurists, but its usage is very much limited nowadays. Bay al-Tawarruk. Tawarruk differs from Bay al-Ina by involving a third party in addition to the borrower and Islamic bank. As compared to the example above, the borrower would buy $10,000 worth of a commodity from the bank to be paid in installments over the next 2 years and sell that commodity on the spot market for an immediate $10,000, which it would use to buy the car. According to Irfan, this complication has not persuaded the majority of scholars that this series of transactions is valid in the Sharia. The IMF states that Tawarruk has become controversial among Sharia scholars because of its divergence of its use from the spirit of Islamic finance. But some prominent scholars have tolerated commodity murabaḥah for the growth of the industry. Haris Irfan states that Sharia boards of some banks have taken a state against Tawarruk and were looking at purer forms of funding. Challenges and criticism. Murabaḥah has been criticized by Islamic scholars who say it should only be used as a structure of last resort where no other structure is available. In practice, in most transactions the commodities never change hands and usually there are no commodities at all, merely cash flows between banks, brokers and borrowers. Often the commodity is completely irrelevant to the borrower's business and not even enough of the relevant commodities are in existence in the world to account for all the transactions taking place. Islamic banking enthusiast Haris Irfan bemoans the fact that not only is the Murabahah money market insufficiently well developed and illiquid, but the very Sharia compliance of it has come to be questioned, often by Islamic scholars not known for the strictness. The following is an example of a Murabahah contract. Adam approaches a Murabahah bank in order to finance the purchase of a $10,000 automobile from cash-only automobiles. The bank agrees to purchase the automobile from cash-only automobiles for $10,000 and then sell it to Adam for $12,000, which is to be paid by Adam in equal installments over the next 2 years. Islamic banks that use this product say that it's not interest because the amount that Adam owes is fixed and does not increase if he is delinquent on payments. Therefore, we're simply looking at a standard sale wherein a trader buys an item for one price and sells it for an increased price. Put differently, the argument for Murabahah is, does Islam allow someone to buy a car for $10,000 and sell it for $12,000? Yes. Does Islam allow someone to make a purchase on a deferred payment basis? Yes. From 1 and 2, neither the bank nor Adam has done anything wrong and Murabahah is permissible in Islam. However, not mentioned here is the fact that the same car that is being sold for $12,000 on a deferred payment basis is being sold for $10,000 on a cash basis. So basically Adam has 2 options. 1. Cash-only automobiles will sell him the car for $10,000 but are not willing to wait to receive the full price. 2. The Murabahah bank will sell him the car for $12,000 and is willing to wait 2 years to receive the full price. Adam's choice to purchase from the Murabahah bank reflects his desire to not pay the full price of the car today. In other words, he prefers to pay part of the price today and be indebted with the rest. The Murabahah bank agrees to be owed by Adam the price of his car in return for the amount that it is owed, being $2,000 more than the price of the car today. Did the bank charge Adam a predetermined return for the use of its money? Yes, the bank charged $2,000 in return for Adam's use of its $10,000 to buy a car. The fact that no penalties are assessed if Adam is delinquent on his payments simply means that the amount of interest in the Murabahah contract is fixed at $2,000. This amounts to a illegal trick to defeat the intent of Sharia.